Welcome to Real Estate Syndicator Live, episode 69. And today we're going to be talking about the 4 big picture tips for vetting co-sponsors. This is probably more important than some other episodes that we've done where we're vetting sponsors from an LP standpoint. This is actually if you are a sponsor and you've been asked to come on a sponsor team, or you're going to partner with other co-sponsors. What are the things that you should be thinking about when doing that? Because I actually think that that scenario is actually more important to some extent to vet your sponsors than if you were an LP. Because if you're an LP, remember, the most you can really lose is whatever investment you make with the sponsor. So if you're investing 50K, that's the most you can use. 100K, that's the most you can lose. But if you're a co-sponsor, you have, general liability combined. So if somebody in your GP does something wrong, then you're going to be on the hook for everybody else's issues. And so it's really important that before you get into a partnership, which is what you're doing, you're starting a business with a bunch of co-sponsors, you're starting a business, you want to make sure you're vetting them. And this actually came up, it was just an amazing conversation we had in our community, the Real Estate Syndicator community on Facebook, and one of our newer member, Kyle, just asked the question, hey, I'm being approached all the time by people wanting me to come in and raise some capital for them kind of at the last minute. What tips do you guys have for vetting the co-GPs? And it was an amazing response. The community just jumped in. So a lot of the stuff that I'm going to talk about today was actually inspired by that post. And I'll give you the link later on how to get there. But here are the four tips. Tip number 1, as you can imagine, we're going to start with the legal tips. So that's what I'll start with the focus on. And from a legal standpoint, you just want to make sure that you are, first of all, if you're a co-sponsor coming in, you want to be doing substantial duties, right? You got to be like a real syndicator with your co-sponsor. And I'll tell you why in a second. But you want to be performing substantial duties. You want to be spending most of your time doing those substantial duties and not spending your time raising capital, because that's one of the issues that pops up. That was one of the questions really in the post that Kyle said, is like, hey, I'm being brought in to raise capital. You want to make sure that you're performing substantial duties. You want to make sure that your primary role, you're spending more time working on those substantial duties than you are raising money or doing all of the selling of the securities piece. And then the last one is you definitely do not want to get compensated based on the amount of money that you're able to bring into the GP partnership, right? So I wanted to go through the schematic a little bit. I usually just talk about it, but I think this will be super helpful to understand why it is that you want to be worried about those 3 things: making sure that you're doing substantial duties, making sure you're primarily involved in those substantial duties, and number 3, making sure that you do not get transaction-based compensation. Most people forget that this syndication LLC, which is, also known as the issuer, legally it's called the issuer. We call it the syndication LLC, which is the one that actually owns the property. Most of us structure them. They've got LPs and GPs, right? So the syndication LLC itself is not raising money for others, right? It's raising money for itself. It's actually taking money from LPs and GPs and using that money for its own account to invest in the property. But the GPs, once you have multiple GPs, they are in the business of raising money from these LPs for the benefit of others, meaning for the benefit of the syndication LLC. So as the GP, you're really raising money for others, which means you, as a general rule, you have to be a broker-dealer. And of course, most syndicators aren't broker-dealers, and that's okay. But realize that the reason they're not broker-dealers is because they rely on something called the issuer exemption. Now, the issuer exemption is probably a misnomer. It's really more like the issuer agent exemption because it applies to the GPs. But the way most of our syndication clients get around having to register as a broker is that they have substantial duties, meaning they're doing the thing, right? They are doing the due diligence on the market. They're building the team. They're doing the underwriting on the property. Then once they get into contract, they're doing due diligence. They're talking to the CPAs, all the things that you do as a syndicator. That's what you do. And because you're doing that, you're clearly doing substantial duties. And so that's where you don't have to register as a broker. But if you're coming in at the last minute, per the question that came in the community, then that begs the question is, are you really doing substantial duties? Because if you're not going to be able to rely on the issuer exemption, which all of the other syndicators that are relying on, probably unknowingly, by the way. Most people don't realize that they have the issuer exemption because they're just de facto doing substantial duties. But once you get into really a lot of co-GPs, it starts to become an issue. So that's really my number 1 tip, is just understand that there are some legal requirements if you are coming in, especially when you're coming in late to the sponsorship. So that was tip number 1. We're going to go through 4 of these. So tip number 2 is be involved from the beginning. The Kyle from our group was saying he's getting approached a lot, sort of towards the end of the deal. People are, again, they're approaching him because they need to close the gap. They're 500 grand short, they're $100,000 short. So the question becomes, is that a good idea? So from a non-legal standpoint, I don't think it's a good idea to come in at the last minute, generally, because if they're struggling to raise capital, that should be almost a red flag. You really want to be coming in at the beginning, not only from a business standpoint, but also, again, from a legal standpoint, because ideally you want to be documenting prior to anybody going out and raising money on the GP team. You want to be documenting it. It doesn't have to be a formal document. Maybe it's a memorandum of understanding, an MOU, or maybe a letter of intent, an LOI. And you want to make sure that you're outlining all of everybody's roles and responsibilities and what percentage of the GP and the deal that everybody's going to get for that percentage. That way, if it turns out that you are bringing in a lot of money, nobody can argue that, hey, you're really getting paid more to raise capital, or you're getting paid more than the other guy or gal because you brought in more capital. If you've got all that documenting at the beginning of the deal, it's very difficult for somebody to come out and allege that. And so you want to outline, ideally, all of the roles and responsibilities in the document, so you've kind of got your get out of jail free card, so to speak, at that point. When you come in at the last minute and you don't have that, it's really difficult for you to show that you have done substantial duties, because if they've already bought the property, so you clearly did not do any due diligence in the market or the team or on the property. You clearly did not underwrite the deal. You really didn't help in any of that. You're coming in at the last minute. It really does beg the question, what in the world are they bringing you in for if it's at the last minute? Now, I'm not saying it's impossible. I mean, it is possible for, maybe the sponsor team's boots on the ground person decided they couldn't do it anymore. So you're desperate to have somebody local, and you bring somebody on boots on the ground, or whatever the reason is. But as long as the reason isn't raising capital, it's going to be okay. But I just think you're putting yourself behind the 8 ball if you come in at the end and you're bringing in 500 grand or 300 grand or what have you. What exactly are you doing in order to justify whatever percentage you're doing? So that's something I would really encourage you guys is if you're going to come into a co-GP team, you want to come in early. You don't want to be coming in at the last minute, because one of the other things you won't be able to do is vet the sponsor team, which is going to be our number 3. So vet the GP team is obviously going to be sort of a critical component, and to be honest with you, it's very similar to the questions and the vetting that you're going to do if you're an LP doing your vetting of the GP team. Like I said, it's going to be much more critical for you as a co-GP, because there's more risk involved for you, because if you do this wrong, you don't do it right. But obviously you want to be understanding what the level of experience is from these sponsors. What's their track record? Have they done this before? Is it their first rodeo? Like what exactly is their track record? And more importantly, or just as important, is what's their track record on this particular asset class, right? If they're raising money for an apartment building, is this experience and track record in that asset class, or are they more specialized in, mobile home parks or self-storage? And maybe this is the first foray into that world. So you want to be aware of that. Similarly with market, are they an expert in the market that you're being asked to come in? Maybe they are experts in the Dallas-Fort Worth market, and this deal happens to be in Alabama or Florida. So you want to make sure you understand what the track record is. And look, maybe they're bringing you in, which would be perfect. Maybe they're bringing you in to plug that hole. Maybe they are experts in mobile home parks, and this is their first foray into an apartment deal, and you are an expert in the apartment deal. So bringing you in to that co-sponsor team makes a ton of sense. But you want to understand what those issues are, what those holes are. So those are some of the questions that come in. You obviously want to make sure that you're aligned with their philosophies and your philosophies. You want to make sure that you understand. But I wanted to share with you guys real quick. I lost it here for a second. I wanted to share with you guys. If you guys go to the Facebook community here that we have at Facebook group, we have really great. We had like literally hundreds of questions that you could ask. So Ryan really crushing on this one. So Ryan, here's like a few examples that you questions you want to ask. Ask them who the GPs are, how many deals have they done, what's everyone's role, who runs the asset management. That's a big one, right? Everybody. Especially when you have a group of GPs that everybody's involved. Who are the people who are actually the 1 or 2 or 3 people who are actually going to be asset managing that? Because that's going to be an important question. Who sends out the monthly newsletters? Who's doing the financials? How many other deals are they raising on? I mean, there's literally hundreds of questions, because Adebayo even came up with all of these questions for vetting GPs, and even came up with his 101 GP questions. So I would really encourage you guys to go over to the Real Estate Syndicator community and look these up, because I don't want to just read them off. But clearly a very, very important questions is just making sure you're vetting and asking all those questions, and everybody's gonna have different questions or what have you. And then the last thing I thought was interesting is another kind of, maybe it's a way of vetting your GPs, but it might not be a bad idea to ask. This also came up in the community. Ask for their underwriting, not only the deals that they've closed, which obviously they like, but also the deals that they've passed on, because that'll give you an insight as to sort of their philosophy, and do they know what they're doing? Do they know how to underwrite? Are their assumptions aggressive? Again, trying to figure out if you're aligned with your sponsors. And so that's another nice way of really vetting the sponsors. But one of the things that I would really encourage you guys to do is don't take the co-sponsor's word for what they're saying. One of the comments in our group discussion was, a lot of people brag about all their experience, about all the ways all the returns that they've given the investors, but when it comes time to actually showing proof of that, I think the word they use was there's crickets everywhere. So you want to make sure you're able to talk to investors or other people that have dealt with this particular co-sponsor. That way you have sort of a verifiable way of doing stuff. One of the things that you want to make sure is, yes, get a hold of the investors that they're recommending, that they've worked with. In this case, you'd be getting a hold of other co-sponsors that they previously worked with. But if you can get a hold of those sponsors that they don't actually recommend or that they didn't actually bring up, and you can go an independent route, that's something I would really, really recommend. And one of the things that's really exciting, one of our members, Jared, brought this up, that, with the advent of technology and AI, especially these days, and blockchain and all this, especially with AI, we really think this is going to become more and more transparent, that all of this information that people are asking for, that they get for, it's probably going to be available for everybody to search. It's probably going to be on blockchain, to be honest with you. All this information about the track record of all the sponsors, they're going to be out there that you're going to be able to verify. And even though sponsors may be a little hesitant to share there, I think there's going to be a huge demand from at least LP on the LP side to have that information verifiable, so that when they are making investments, because the technology is going to be there, that you can have all that information. So right now it's so opaque. You're trying to figure out what the experience is of the sponsors, but you don't really have a way of verifying it very easily. And so with blockchain and AI, I think that's gonna come. If you guys have a question, pop it in the mail. There was a great question that came in, and it's in the chat. So if you guys want to drop another question in the chat, which was, how involved do you have to be in order to protect yourself from being, I'm sorry, let me do that. How involved do you have to be involved to protect yourself from the determination that you were compensated for being an unlicensed broker-dealer? This is the tricky part, right? Because in order to avoid being considered a broker-dealer, or at least be under the exemption of a broker-dealer, you have to be doing substantial duties, which is a very nebulous term. Most of the case law or the no action letters that are out there right now really focus on the transaction-based element. So clearly, if you're getting compensated based on how much money you're bringing in, that's going to be a problem. You guys have all seen the emails that go back and forth about, hey, I'm looking to raise my last 300 grand or 500 grand. If you can bring this in, I'll give you 5% of the GP. And if you can bring in more, I'll give you more. So the compensation, which again, GP shares are a type of compensation, doesn't have to be cash. When that's tied to whether they can raise money, that's problematic. And certainly if it's tied to how much money they can raise, that's problematic too. One of the questions you should ask yourself, for example, is, well, what happens if I don't bring in any money? Like you're getting brought in as a GP team, you're getting promised 10% of the deal, you're expected to bring in a ton of money. It turns out, let's just say you didn't bring in a dime. Are you still going to get the 10%? And the answer should be yes, because again, you're not tying that 10% to the amount of money you raise. So that's an issue that a lot of people have, because they have this agreement, usually it's the management company and everybody's a member of that. But once you become a member of that GP, you can't just get rid of them because they didn't bring in enough money. So that's one of the consequences that starts popping up when people are starting to make promises of how much money they're going to give in exchange for the GP. But specifically, substantial duties is one thing, but also you've got to spend more time than not. You've got to spend the primary, which to me just means 50% plus one, most of your time working on the substantial duties versus raising the capital or dealing with the raise. And so that's just a timeline thing. Like, how much time did you spend working on the actual asset management? Once the property closed, once the deal closed, how involved were you? What were your roles? What did you do over the next 5 years of the deal? What was your enrollment? And if you didn't do too much, or you just showed up to a couple meetings, that's not going to be spending more time on the substantial duties. But again, think of the duties as all the duties that a syndicator has to do. And there's no black or white answer because it depends on how much percentage you have, right? If you own 50% of the deal, I would expect to see you doing most of the work, right? You're probably doing the due diligence underwriting. But if you're only getting paid 2% of the GP because, you've got a full-time job and you're doing this as part-time or you're just trying to learn, then obviously, your role would be, probably less expected. But substantial duty is a very nebulous term. A lot of people try and figure out whether being an investor relations, let's talk about that real quick. A lot of people try and figure out if investor relations is enough to become substantially involved. And I think the answer to that is it depends. All of this really depends on the facts and circumstances. But I've seen structures where everybody is an investor relations to their own investors, and I think that's a big no-no. I mean, an investor relation is the liaison between the company and the investors. There should be one. There's no reason why there should be more than one. And if you've got 3 or 4 investor relations people that only deal with their own investors, that's going to be a huge red flag if an auditor is looking around and trying to and questioning whether you're doing substantial duties or there's something else. If all you're doing is communicating with your investors, then that's going to be a red flag. How much you're getting compensated is also going to be an issue because, again, an investor relations person you can probably hire for $60,000, $70,000, $80,000 a year, maybe a little bit more. But if you're getting compensated through the GP and you end up making $200,000, $300,000, $400,000, that's also going to be a fact that's against you. But again, I think it's a sliding scale. It depends on how much of, number one, of the GP do you own, and number two, how much money are you bringing into the deal. So it's in my world, it's a sliding scale. Let me give you a great example. One of our clients hired an engineer, I believe it was, who had a full-time job. And so he came in and helped with some underwriting of secondary and tertiary markets that the sponsor wasn't involved. They wanted to expand markets, and they brought this person in to do some underwriting on some other markets. He would just do this on the weekends and on the evenings. So that's the only time he had time. And in exchange for that, he got paid 2% of the GP, a very small amount, and he was doing for him, it was substantial duties because he was doing real work other than raising capital. In fact, he wasn't raising any capital, right? He was doing substantial duties, which was that underwriting. Now, if he ended up having to if he brought in a couple of people in there and they invested, it's probably not a big deal. But if he brought in, $500,000 and instead of getting 2% for that work, he was getting 15, 20, 25%, that would start to look like a red flag as well. So it really is a sliding scale as to what you can do. So hopefully that answered the legal part. I don't know if anybody has any other questions on that. If you already drop it in the chat, and if you're getting value for this, please like the video and the show, which is every Wednesday at 4:30. But if I don't see any other questions, that was kind of my little rant on vetting co-GPs. Really, really important to understand the legal part because the reality is, as I mentioned before, the unfortunate reality is that when people get together more than 3 or 4, certainly when somebody's being brought in late into the game, which was the main really impetus of the question, then it's generally because they're coming in to raise capital. So just to summarize, number one, you want to make sure you're doing substantial duties and your primary role is focused on those primary duties. You want to make sure you're involved from the beginning. Don't come in late into the game. Number 3, you absolutely want to vet the GP because it's probably even more important for you to be vetting the GP versus an LP because you've got way more to lose, not only your reputation standpoint, but also from the standpoint of risk. I mean, general partners, everybody's legally responsible for everybody else's actions. So you want to be careful there. And then you want to make sure that, I think a good tip would be to make sure that you're asking for underwriting, not only of deals that they've completed, but for deals that they didn't go through, so you can go through and figure out what their thing is. So I don't see any questions in the chat, so I will leave it at that, and we will see you next Wednesday at 4:30, same channel here at the YouTube channel. Thanks, everyone.